Hello everyone, welcome to a channel that not only talks about stocks, AI technology, and digital currencies, but also shares various news. I am Ajie. What are we talking about today? Mainly review the entire month of August details of interest rate cut transactions. Afterwards, we will make a forecast for September, the non-farm payroll outlook. So today I will share with you the big non-farm payroll data that will be released this week. And first make an outlook on how to deal with the entire September. So without further ado, let's get started. Let's first summarize some data for August, including the last week of August. Firstly, let's take a look at the entire month of August, where the US dollar index fell by 2.2% and the 2-year US Treasury yield fell by 34 basis points, which is a significant decrease. The yield of 10-year US Treasury bonds fell by 15 basis points, but the TOT fell by 0.4, which means the entire interest rate curve is becoming steeper and steeper. We call this steepening, and the 2-year decline is relatively large compared to long-term US Treasury bonds. US Treasury bonds with a maturity of over 20 years have even experienced a slight increase in interest rates. The spread of junk-grade bonds has fallen by 6 basis points but remains relatively low. The three major indexes actually rebounded quite well throughout August, with the S&P 500 at 1.9, the Nasdaq at 1.6, and the Dow Jones at 3.2. So the entire month of August actually ended with zero gains for the Dow Jones Industrial Average. Of course, the Russell 2000 is the best performing index among all, with a 7% increase. If we believe that the entire month of August was led by big technology, it is entirely our personal feeling, and this feeling is not supported by data. In the early stage, major technology stocks rose by 1.9, and the equity index rose by 2.7. So the performance of S&P 493 is superior to that of large-cap technology stocks. From the perspective of the sector, the leading sector, banks, rose by 5.6%. While the healthcare sector rose by 5.4% in the past week. I have shared with everyone on X account that if we believe the market is on the logic line of trading decline, the banking sector, as a very cyclical sector, should not show such strength. It has seen a nearly 19% increase in the entire banking sector so far, ranking second among all sectors. Additionally, the last Russell 2000 is something I would like to specifically point out. Throughout August, without realizing it, we may not have paid attention either. As the Russell 2000 rose by 7, actually thinking about the logical line behind this, what is the most important data for our entire August? The non-farm payroll data exploded in August, and it was at the beginning of the month. So, in the midst of a big non-farm payroll data explosion, let's take a look at the entire month of August. And it was actually the Russell 2000 that performed the best, that is to say, trading something. The market is following the logic of interest rate cuts in trading and has not entered a recession. If the market enters a recession or is in a trading recession, the Russell 2000 should not rise. At the same time, the banking sector should not experience an increase. So, something similar to the market trading is what I have previously shared with you about the most favorable environment for Russell 2000. With an economic growth rate between 1% and 1.5, which we call 3 parts. It is slightly lower than the 2% economic growth rate but still remains there. We are not entering a recession. Meanwhile, the Federal Reserve has entered a cycle of interest rate cuts. This macro environment is actually the most favorable for Russell 2000. It's somewhat similar to the period from 1716 to 2019. Market participation. As of last Friday, the S&P 500 20-day moving average is 67, the 50-day moving average is 63, and the Nasdaq is relatively lower at 58% and 52%. So both the Nasdaq and the S&P 500 are in a neutral optimistic position. How to quickly understand the current market participation or emotional indicators? You can use my app on the home page to see the participation rate of the 20 moving averages, 50 moving averages, including the panic and greed index of CN. As of last Friday, it was at 64, which is also in a neutral optimistic position. How do I download it? It's very simple. Open the Google or Apple Store, search for Invest in Ajie directly to download, or scan the QR code in the bottom right corner of the screen with your phone to download. Our mainland Chinese audience needs to download VPN to open it. When we arrive in September, it means that the second quarter financial reporting season is basically coming to an end. Coincidentally, we are also going to summarize the financial reporting season for the second quarter. Similarly, when we look at the data, we may find that our subjective feelings or some of the feelings around us are not so supportive, not so real, and do not have some data support. What does it mean? Let's take a look at the first chart. What we see is June 30th, before entering the second quarter financial report. The market expects the year-on-year growth rate of EPS for large technology stocks and the year-on-year growth rate of S&P 493 EPS in the previous period. Before entering the earnings season on June 30th, the market believed that Max 7's top 7 technology stocks would have a second quarter EPS growth rate of 13.9%. While S&P 493 only had a 2.5% growth rate. After the end of this quarter, the growth rate of the final batch of large technology stocks in the early stage has reached 26.6%. Significantly higher than market expectations, but it does not represent the S&P ideology. S&P 493 is not doing well. The growth rate of the last batch of S&P 493 stopped at 8.1, which is actually significantly higher than market expectations. So, in fact, the entire second quarter financial report, whether it's S&P 493 or early big tech, has performed well. S&P, the technology stocks in the early stage will be relatively better. Of course, one thing I need to emphasize is that almost every quarter before the financial report is released, the final EPS growth rate will be better than market expectations, and the range of good results is actually very wide. Basically, around 75% to 85% of companies will exceed market expectations. This is basically a high probability event. Let's take a look at these two plates in the bottom left corner from the perspective of the plates: communication services and information technology. The technology sector and communication services represent many major technologies. We can see that, for example, before entering the financial reporting quarter, the final data for communication services was 45.6 on 29.4. The technology stocks are actually fine, with an expected final number of 16.4 and a final data of 22.6. Let's take a look at the financial sector, which is something I particularly want to point out. Before entering the financial reporting quarter, the overall year-on-year growth rate of the financial sector was only 2.2%. And the final data was 12.9, which was 10% higher than the market expectation. So it makes sense for the entire financial sector, especially the banking sector, to rise. Ranked fourth is the S&P 500, and the following sectors in terms of gains are all smaller than the S&P 500. The entire second quarter rose by 11.9%. But everything was good, and basically all sectors were better than market expectations. The only relatively poor sectors are the utility, infrastructure, and materials sectors, which are slightly weaker than the market's expectations. Overall, I remember sharing the EPS growth rate with everyone 2 weeks ago, and this data is also a fact. The EPS growth rate for the entire year of 2025 is 10.3%. Similarly, after Nvidia's financial reports, more and more companies have come in, but in the end, compared to 2 weeks ago, not many companies have come in. The current market expectation for the entire 2025 EPS growth rate is 10.6. I remember saying when it was below 10% that this year, I believe the EPS growth rate may stop at 13% to 15% by 2025 if we stop over there and look at it from this perspective. Even if the current EPS looking forward is indeed at a relatively high level, if it ultimately outperforms market expectations, then the current EPS may not be as expensive as it seems. Of course, looking at the feedback from the market at the end, it doesn't seem as positive for the entire financial quarter. There have been a few instances of selling the news, but it's just a little bit, not that comprehensive. What does it mean? 181 companies had better than expected EPS results, ranging from 0% to 5%, while the average decline for these 180 companies was 0.9%. Normally, a very good financial quarter, this number should be on a positive curve between 0% and 1. This is a normal outcome. So from this perspective, there was a little bit of sell news in the second quarter. 173 companies exceeded market expectations, ranging from 5% to 20%. These 173 companies are very normal, with an average increase of 133 companies have exceeded market expectations, ranging from 20% to 40%. With an average increase of 3.0, which is relatively reasonable from the historical average of the rise and fall. If better than expected in the financial report, it should have risen by 1, and this quarter only rose by 0.4 if it falls short of expectations, with a decrease of 2.4%. It has dropped by 5.5% this quarter. So indeed, this picture is very intuitive. The market has very high requirements for financial reports this quarter. Okay, after discussing the financial report data for August and the second quarter, let's talk about September. Let's first talk about some macro data we will face in the first week of September, among all the macro data we will see this week. Friday's big non-farm payroll data is the most important. Firstly, the market's expectation is that the big non-farm payroll data itself will increase by 75,000 people, with an unemployment rate of 4.3% for 75,000 people. Bloomberg's expectation for the big non-farm payroll data is 93,000 people, with an unemployment rate of 4.2%. In fact, a month before the last Big Dipper, after the release of the Big Dipper agricultural data, there was a decline that mainly caused market panic. The main thing that panicked the market at that time was that the large non-farm payroll data had a very large downward correction for the first 2 months. Bloomberg and their team conducted this research, and after their research, it is highly likely that when the large non-farm payroll data is released this time, the data from the past 2 months will continue to be revised downwards. Therefore, theoretically speaking, the large non-farm payroll data is one aspect, and the correction for the first 2 months is another aspect. The last aspect is the unemployment rate of the entire labor market. In fact, from the perspective of the Federal Reserve, they value the unemployment rate more because it reflects both the supply and demand sides. When you put both ends together, you get this unemployment rate, while big non-farm payroll data only reflects the demand side. So why do Bloomberg and others think it will be better than market expectations? They indicated based on some labor market indicators that it mainly comes from the employment population mainly comes from 3 aspects: local government, entertainment services, and construction industry. While the unemployment rate is 4.2, which is 0.1% lower than market expectations, it's for the wrong reason, not a good reason. What does it mean that it's not a good reason? Firstly, we need to distinguish between the 2 sets of data consisting of big non-farm payroll data and unemployment rate, which have completely different statistical approaches. It does not mean that big non-farm payroll data is better than market expectations. So the unemployment rate is also better than market expectations, and there is no relationship at all. Let's look at them separately. Okay, let's take a look at the unemployment rate. First of all, the unemployment rate I mentioned earlier has 2 different dimensions. Looking at the data that makes up the unemployment rate, the total labor force will decrease by 8,000 compared to 260,000 in the previous month. Why did your unemployment rate actually decrease instead of increasing when the labor force decreased? It is because the overall decline in the employed population is greater. Can this be understood? In total, we look at the unemployment rate by dividing the unemployed population by the total labor force. But if the denominator of your total decreases by a greater magnitude, which would actually lead to a decrease in your unemployment rate, then if such a result occurs, for the market, if Bloomberg's prediction is correct, or even if the market's expectation is completely in line with market expectations, how will the capital market react if such a result occurs? I personally think that if it is such a result, whether it is the current market expectations of unemployment rates of 75,004.3 or Bloomberg's expectations of unemployment rates of 93,004.2, I think the market is acceptable. It means that there will still be a 25 basis point interest rate cut in September. But it is possible that Powell will make a hawkish interest rate cut at that time. but if the final result, such as a large non-farm payroll data of 150,000 or even 200,000, or if there is no downward revision for the first 2 months but an upward revision is much better than market expectations, then the market may actually experience a decline. Why? Actually, it's the logic I mentioned at the beginning. We want to recall what was traded in the market throughout August. What the market trades is not a recession, but a logical line of interest rate cuts. So, the yield of 2-year US Treasury bonds has experienced a significant decline, accompanied by a 7% increase in the Russell 2000, and this month has been reversed. If a set of very poor non-farm payroll data last month resulted in a 7% increase for the Russell 2000, then if this time the non-farm payroll data is significantly better than market expectations, the Russell May 2000 be under pressure. On the contrary, for these big technologies, I personally think they are completely acceptable and okay, representing that the entire economy is not too bad. But the market originally had 3 interest rate cuts from September to December in the next 3 months, and this optimism should be partially restored or reversed. Pulling back the magnitude of this interest rate cut may not be as friendly for small cap stocks. Finally, Bloomberg and his team believe that the labor market data for August will not guarantee a rate cut in September. I don't completely agree with them on this point. Bloomberg believes that the CPI data for August will also affect the interest rates and decisions for September. And the specific results will be announced on September 11th, while the Federal Reserve's meeting is on the 17th. I personally think so. The first point is that the time in between is too short. The second reason why the Federal Reserve has turned around is not because of CPI data, nor is it because of inflation. Inflation is actually within their expected range, except for the fact that the core service for inflation was not so good last month. They can actually accept inflation, and they can accept this short-term rebound. It is entirely the labor market that can make them consider cutting interest rates in September. So this time after the labor market data is released on Friday. It can be basically determined whether there will be a rate cut or not in September. I said if it's very good, there may not be a rate cut in September. For example, with a large non-farm payroll data of 200,000 yuan, the probability of a rate cut in September may immediately drop to 50 or even lower than 50% per 100. Okay, let's talk about how I prepared for this big non-farm payroll data, including the entire month of September. When we went back to broadcasting, in fact, at the end of July, the market believed that there would be a pullback in August. However, in August, and especially in early August, the big non-farm payroll data exploded again, and the market believed that a recession was coming. This labor market is not working, but in the end I realized that I remember that day very clearly. After the release of the big non-farm payroll data, it fell by 2%. I posted an X message saying bad day, and many people below the X message said that there has been a macro change. I remember the comment with the most likes, with a total of 60-70 likes. Everyone thought that I said a 2% decline was bad day too early and that there was a change in the macro situation. Now let's take a look. From that wave of decline to now, the index has risen by at least 4% to 5. You can see that the Russell 2000 is going up 10%. So in July, everyone thought that August would fall, especially with the big non-farm payroll data at the beginning of August. Everyone believed that the possibility of a decline was even higher. To some extent, I think it is actually related to everyone's position. So now it's the same. We're at the end of August, now we're at the beginning of September, and everyone thinks September is going to fall. That's true. September is basically from January to December throughout the year. According to this historical trend, September is the weakest month. The probability of a relative decline will be much higher, and there is actually a reason behind him. One of the main reasons is that basically after late August, those fund managers, including some hedge fund managers, went on vacation and traveled. September is the day when they return. The day when the liquidity of the entire market returns again, so the volatility may be relatively large. But is it simply because of this volatility that they choose to short or choose large? I personally don't think it's necessary to significantly reduce positions. Of course, there is another perspective. The market is relatively bearish because the VIX is currently at a relatively low level. However, in a bull market, the VIX can remain at a relatively low level indefinitely. So my opinion is that whether it's the release of this week's big non-farm payroll data, how it will go after the data is released, or how the entire September will go, I think we still need to take a step back and look. I used to share with you 3 perspectives on taking a step back: whether the economy is in recession, these signs, and whether we are in a cycle of interest rate cuts, including capital expenditures on AI. After seeing Matt's financial report, should we remain pessimistic or optimistic? So I think this is a bigger direction. As for when it will fall, to be honest, no one knows. You rose well in August and think that September will fall. If September doesn't fall again and then remains flat, you think that October will fall again. Then you will be right for a month. Looking back, can you see the wave of gains in July? Increases in August and then increases again in September, or a sideways trend even if it falls again in November or October, falling to the level of July and August. You will find that you are still buying at a high point, so instead of predicting which week or month it will fall, it is better to bring your very reasonable position. Keep enough comfortable cash, and if it falls, increase your position. I think that's enough, okay? And to be honest, I have also shared with you the participation rate of the entire market before. If today's market participation rate really reaches 80 or 85, and combined with September, it is a very weak month. For example, there is also big non-farm payroll data, and I have been talking to everyone about it. Before releasing the data, a setup of the entire market is very important. What is a setup? It refers to how full a market position is and how high the emotional level is before entering this data. If your emotional level is very high and your position is very full, then this event itself can become a catalyst and an opportunity. You can have a very full position and a very high emotional level, even if there are sell news. If you have a set of relatively bad data, there is more reason to go down. Tell you about the recession and wait. In fact, the market is using these events themselves to engage in profit-taking behavior. So now the market participation is not in an extremely optimistic situation, although I can understand that VIX is in a relative position. And September is a relatively weak month. It completely depends on everyone's personal choice. If your position is really full, I can understand if you lower it by 5% or 10. Otherwise, if your current position is only 50, you say you still need to lower it. I personally don't think it's necessary because you only have 50% of your own position at the moment. What you should consider now is to take a step back and see if we are in a continuation of a bull market. If so, you should consider when to increase your position rather than whether you still need to hedge. I don't know if you can understand the possible decline in September. Okay, finally, I would like to introduce to you the new feature of my app, Beta Calculator. This feature actually took them about 3 to 4 months, and now it has finally been launched. After going online, I strongly recommend everyone to give it a try because it's free and can be used once a day. Here I gave an example, such as adding Tesla, Disney, AMD, and having a cash position. I am using SHI as a proxy, S&P 500EZ, direct S&P 500EZ ETF, and QQ's index. After entering the number of shares separately, I saw the final overall North Tower investment with a position of 1.5. How to understand that the beta of 1.5 represents a fluctuation compared to the S&P 500. Your overall investment portfolio fluctuates at 1.5 times the S&P 500. If the S&P 500 rises by 1, then you will have a slightly larger increase than the S&P 500. Similarly, if the S&P 500 falls by 1, your decline will be relatively larger. Beta is a great way to control or understand how high the overall investment portfolio is currently taking on this risk. For example, at the beginning of the year, I shared with everyone that I wanted to downgrade beta. But many viewers didn't even know what it was. What is beta? With this tool, the first step is to put all your positions in it. Then the second step is to understand how high the beta you are currently undertaking is. You can make some adjustments to the future by reducing the beta by one stock. After the reduction, take a look at the current beta and see if the adjusted beta is acceptable.